Welcome, guys. Welcome to another week of the Educated Homebuyer Live with just myself this week. Kind of taking it back old school. Josh is not here this week. He's golfing. So just me, myself, and I here to answer your mortgage and real estate questions, help you guys become the educated home buyer. Do me a favor, let me know in the comments that you can actually hear me. It's always a good thing, because when you're talking by yourself, you don't have anyone to bounce it off of. Make sure you can hear me clear. Let me know where you're watching from, and then also start putting your questions in the chat. We're going to do like we normally do. We're going to roll through some charts, take a look at inventory, demand. We're going to take a look at basically what's happening out there with some different economic things, what's impacting both the rates, the housing market, all of that good stuff, so that you guys can make logical, not emotional decisions when going through the home buying process. But I got some feedback. I am loud and clear, so I appreciate you guys letting me know there. And also, again, let me know where you're watching from. So what I'm going to do is always what we always do, and that's jump into some charts here, take a look at them. And as we're doing that, again, start putting your questions in there. We'll get to them and help you guys, again, go through this home buying process with some logic. So let's go this direction right here. And so we're going to start out looking at inventory. Inventory tells the tale, and at the moment, it is telling us that there's more homes coming on the market. So we are back to 2019 levels with inventory continuing to climb, which is likely going to happen over the next couple of months. 768,000 single-family homes on the market at this time. That's up 1.5% from the previous week and 33% over last year. And with that, we saw inventory rise from 756,000 homes to 767,000 homes. That is our peak at the moment. That's where we are. But for context, taking us back to 2015, we had 1.124 million homes on the market. So slightly higher than where we are at the moment. Orange County continuing to see inventory rise, up 2.06% week over week. That's 4,556 homes. This is the highest level, again, that we've seen since probably 2019 as well. Huntington Beach sitting at 301 homes, and that's up 7.31%. I've got homes on the market, put 3 on the market last week. One of them has an offer, potentially a second offer. Well, there will be a second offer probably tomorrow. And then the 2 others are getting showings, but no offers yet. So there is buyer activity out there, but there's not the rush, the panic that we saw, a couple years ago. But inventory is continuing to grow. And so that means more options, more choices for buyers, which ultimately is a good thing. Now, the next chart we're going to look at is one that I like. This is active inventory, showing you, what it looked like between 2019 and April of 2019 to April of 2022. Now, the areas in the dark brown are where inventory is 50% below, where it was back in 2019 compared to 2022. And those areas that are green obviously had inventory higher than the market at that time. So that was back in April of 2022. Now we look at the same chart and you can see April of 2019 versus April of 2025. Most areas here are pretty close to where we were back in 2019. You see areas of the Northeast, up near the Great Lakes, some of that area. There's spots kind of running through part of the West there where there's still some brown and inventory is low. But for the majority of the United States, starting to see more active inventory. Look at Nevada, look at Texas, look at Florida. Those states where inventory has really grown the most, 30% or so of the inventory at the moment that's on the market is sitting in Texas and Florida. So those areas have seen the biggest push in inventory. They hold the most, but they're also pretty big states with big populations relative to some of these other markets. But seller growth continues to grow over 2024. We had 74,000 homes go into contract this week. That's up 8.3% over where we were in 2024. We also have sales beating where they were this time last year. And it's not really because demand is strong, but one reason is last year was pretty weak this time of year because interest rates were essentially higher than where they are today. It's hard to believe because interest rates today are pushing that 7% number, but back the same time last year, interest rates were over 7%. So demand was subdued because of that. And because of that, we weren't having the growth out there in the market. So home sales for May will probably exceed 2024. So we had 74,000 homes went into contract this week. That's up 8.3% over 2024. And then the median price of pending sales is at $400,000, up slightly from last week, and just 0.25% rather above where we were in 2024. And then price cuts. So price cuts continuing to climb here. 37.4% of active listings have some sort of price cut. Again, it's all about context, right? You know, if a home comes on the market at $100,000 and somebody cuts it to 999 or 99,999, that's a price cut. A dollar difference is a price cut. So some of these aren't true price cuts, but there are some markets out there where you're seeing some sizable price cuts, and those are the markets that you probably want to pay attention to if you're a buyer. Remember, real estate's local, so it doesn't matter what's happening in Florida or Texas. If you're in, New Hampshire or Maine, where, you're still fighting competitively to get a house under contract, and vice versa. It doesn't matter what's happening there if you're in an area that's seeing a lot of available inventory. So this chart here is the 1-year change of home prices in America's 50 largest metros between April of 2024 and April of 2025. You can still see chart's very hard to read from my side, but Cleveland, Ohio, New York, Connecticut, a lot of the areas, Kentucky, was that? I can't even read what it says here. Providence, Rhode Island, a lot of that Northeast that we kind of talked about there, still seeing, home prices grow year over year. Whereas the markets that are suffering the most are those, Tampa's at the bottom, Austin, Texas at the bottom, San Antonio at the bottom. Those areas where we've seen the most inventory growth are those markets that are slowing down. Now, this is a chart that we're going to take a look at that has to do with interest costs. So this is one of the things that Josh and I have been talking about for the better part of 2 to 3 years. And one reason why we felt that interest rates couldn't get high and stay high for an extended period of time, because the higher interest rates we have, the more debt cost that the government is paying, right? They're paying more money on to service their own debt. And so as debt continues to rise, with interest rates moving higher, it costs more and more money to service that debt because it's growing and rates have been staying high. But at the moment, we're paying somewhere around $1 trillion a year in interest on our own debt, which is expected to grow to over 2.2 trillion by 2034. So, 9 years from now, interest cost is probably going to double with our debt rising and rates, depending on what happens to rates, that number could change. But at the end of the day, we're paying a lot of money to service this debt. So is it sustainable? I don't think so, but I also don't know what the solution is, right? I mean, we've talked time and time again about, politics and people wanting to get elected. This isn't how you get elected. You don't say you're going to go out and start cutting things, because that doesn't get you reelected. What gets you reelected or elected is saying that you're going to spend money in order to help people. And that's how people get in this position, right? They get elected, and then we continue to see debts grow. And, while people do try to bring in the reins, the reality is it's hard to control. And quite frankly, I don't know what the answer is. So Josh threw in some charts, as he always does. He's not here to explain them. But one thing that we hear all the time is that the younger generation isn't making any money. The younger generation has it way worse than the previous generation, so on and so forth. So he went through some different charts that he came across, and just shows, median inflation adjusted hourly wages by sex and generation at a given age in time, right? And it goes through the different generations here, and you can see where we are based on where the previous generations were at that time. And the reality is, more money being made at the same age as when, the different generations were at the same age. Now, again, housing costs are out of control. There's different things out there, but the reality is it's not quite as bad as it's, people want to make it look. Now, this chart shows millennial wealth relative to Gen X and boomers. The millennial wealth in blue is relative to Gen X, and then the orange is millennial wealth relative to boomers. And you can kind of see where wealth is based on where boomers were in this whole generational cycle. So again, just throwing them in here for Josh. He could probably explain them better because he had some idea of what he was doing when he threw these in there. And then here, median real wealth by age, adult age and generation. Again, just showing that the generations aren't as bad as people want to make it out to be. So, timeline of Trump's second term tariff. So, we talked about tariffs many, many times on the show. We've talked about the changes in tariffs. And I'm not going to explain this chart in detail, but you can see, where we started at the beginning of February, and where we climbed to and where we are now. So we climbed as high as 41% on, no, it's actually higher than that. I mean, we were over 100% in China and some different things. Now we've pulled back. We got this 90-day pause on 115% of China. But you can see where we were. We're slightly above halfway on this tariff thing. But the reality is tariffs are higher than they were, and they are having an impact. The major imports hit at the moment through May 19th. Big one is cars, SUVs, minivans. Next one's computers, phones, vehicle parts. A lot of that stuff is being impacted. So the reality is you're probably going to see, if you haven't already, if you're in the market for one of these, the cost is going to be higher than it has been previously just because of that, what we're paying on imports. So inflation is something we've been watching. Last week when we did the charts, we showed that what's falling off in May and June are basically zeros for inflation at the moment. Through May, where we have at the moment is they're expecting a 0.12 for May. So either way, that's if it comes in at 0.12, that's going to be rounded down to a 0.1, which either way means inflation is going to move slightly higher. You're going to see the headlines that inflation is still here, inflation is higher, so on and so forth. But a 0.1 annualized over, an entire year works out to be quite a bit less than 2%. So, we just have to give this time we just have to give time for this whole thing to work out to see where inflation is. But at the moment, we're not seeing crazy numbers come in with tariffs, with, taxes that are happening out there. And the reality is that stuff takes time. It takes months, weeks, months to work through the system. So it'll be interesting to see, to pay attention to this, to see where we are in a couple of months. Truflation shows us at 1.91%. Again, this is a real cast, so they're taking everything into consideration. So that's under the Fed's target, but also understand that this jumped 0.7% or so since last reading that we had here. So there is a jump there in the Truflation numbers. Again, you got to take it with context. This is something we'll pay attention to, not something that the Fed's making decisions based off of. This is the Fed GDP now for Q2. Last week we were sitting at 2.5, or the last reading we were at 2.5. We're at 2.4. Well above where we were in Q1. It's above the blue chip consensus. So again, this is something we continue to watch, but I think the next reading is in a week or so. So we'll get a better indication of what GDP looks like through May at that time. Now, this is a chart of the 10-year. I draw it a little bit differently than Josh did. I just started new, wiped away all the lines. And at the moment, the 10-year today closed over 4.6, which is the highest level that we've seen in quite some time. Not really a lot of data out there to support a higher move. Part of the reasoning, the belief behind a higher move is that a lot of the big traders, a lot of Wall Street is already on Memorial Day break. They're already out of the office. So you have fewer traders in there, putting in orders or what have you, and it can move the market in ways that wouldn't normally move because, there's just less people out there to manipulate the market. That said, this chart's not pretty. It looks like we could move up to that top line there, which is, I'd said last week 4.7. Josh called me crazy. I think that we're pretty close to moving in that direction. But we'll see. I mean, one reason that interest rates haven't jumped well above 7% at the moment is because we've actually seen the spread on the 10-year actually come down a little bit. And so it's allowed interest rates to stay right at that 7% mark, which is where we are today, just over 7%. Last week, we were at 6.95 or so. So, it is what it is. You guys, know that if you have good credit, down payments, that sort of thing, you're probably getting an interest rate under 7%. In fact, I received a call today from a lender buddy of mine, who, if you have a jumbo loan, or a non-conforming high balance loan, rather, over 806, 500, or whatever the number is, on a 10-year, he's doing 5.75%. So there are deals out there, especially on adjustable rates. You need good credit. You need that sort of thing. So with that said, if we can be of assistance to you in that realm, you have questions, you go through the pre-approval process, you can use that link scrolling at the bottom there to get in touch with Josh or myself and help guide you through that process. So thank you guys. Thank you for going through that with me. 16 minutes. It is difficult to talk by yourself. I forgot how hard this is. All right, guys, I appreciate you being here. We've got Cleburne in Little Rock. Who else do we have in the house tonight? That's the only one letting me know where they are. So we do have some questions, though. We're going to dive into those. But do me a favor. Let me know where you're watching from. Also, start putting your questions in there. It makes the show flow a little bit better, helps me, so that I don't have to sit here and just make up things to say and or cut the show early because no one's talking. Miscellaneous of the whatever is in Vegas. Also a normal. I don't know if you're normal. A regular viewer here on the show. So what we're gonna do is, it's a little bit more difficult because I have to read the question and then decide if it's a question or a comment before I put it on here. So, I'm just going to put things on here and read them so I don't look crazy just reading the screen. So Sam says, great content. I wanted to know you all could provide online resources for discussing good mortgage lenders and compare contrast working with a licensed realtor in any of the 50 states. Can you explain? So we've done a lot of different content on helping you select the right lender, helping you shop lenders, if you will, helping you select the right realtor. So if you search the channel, you can get a lot of that content on how we've kind of dug into that process, both here on my channel as well as the Educated Homebuyer channel. If you're not following the Educated Homebuyer, I would say go check it out. Podcast is a little bit more in depth than my channel. I spend, on a video 10 to 15 minutes kind of going over a topic, whereas Josh and I take probably 25 to 30 minutes going over topics in detail. You get two different people's opinions versus one. So it's a little bit different style of content, but it's really to help educate versus just kind of surface level stuff. So go check out the Educated Homebuyer if you haven't done so. You can subscribe to that channel and help us continue to grow. But with that said, working with a realtor in regardless of the state essentially is the same, right? You same protocol. You're trying to find a professional in the market that you want to work with. Now, I end up referring people all the time to different agents across the country because they reach out looking for a real estate agent. If you need somebody, I network with a lot of agents, happy to refer you, but you're looking for the same thing. You're looking for a professional in that market, somebody that understands it, somebody has experience, somebody that's local, and ultimately somebody that can break down things in a way that you can understand. So if you need assistance, definitely reach out. Happy to refer you there. What do we have? So, here, just for context, Daniel says, trying to buy a home in central New Jersey. Starter home is a pain. So basically, New Jersey is one of those markets where inventory is still low, still very difficult out there. It's hard to get offers accepted. Whereas, if you're in South Florida, it's probably a different scenario, but it's paying attention to these markets, these trends is smart because ultimately, it's all about being local and knowing what's happening in your market. S House is in Vero Beach. G Money is in Savannah. So Steve says multiple family found. Okay. So a multiple family home, I'm assuming, found mold in home inspection and termite damage. Deal breaker, question mark. I would say termite, not really a concern, in my opinion, on most properties, unless it's to an extent where the structure is being affected. Typically not the case. But could it happen? Sure. But so I say termites typically not a deal breaker. What they're going to do is they're going to tent the property in most cases if it hasn't been done if it hasn't been done in the last 10 years. And then they, go back and fix all of the woodwork that was impacted by the termites. And that essentially gets you the clearance on the termite. As far as the mold goes, mold is a tricky thing. If it's just a little mold here and there, where a shower and there's some on a ceiling because there's not ventilation, that's one thing. If it's where water's been leaking into a wall for an extended period of time and mold is growing and it's black mold or some sort of dangerous mold, that's a whole different problem. And in my opinion, mold inspections can be one of these things that can be blown out of proportion in some cases. And in some cases, it's rightfully so. So it's very, very difficult to say. Like we had a property about a year ago from a client that was buying one here in Westminster. And when I could smell just the stench of like mildew in the house. So something didn't smell right. We got the mold inspection back, and basically every area that they tested, the levels were out of control. That for me is a red flag. I would be out just because of the potential harm it can do to your body. Whereas if you got levels that are slightly above and it's only in one controlled area and it's, easily fixable, then I don't know that it's that big of a deal. But there are people that out there that have allergies to this sort of thing, that have real health issues pertaining to mold. So it's one of those things that I don't take it lightly, but also don't blow it out of proportion either, if that makes sense. Heather is in Inglewood. Thanks for being here, Heather. Steve also followed up, when is buying season over? So buying season is really never over, but the spring buying season is kind of over right now. We're moving into summer in a lot of markets out there. A lot of kids are getting out of school, especially on the East Coast. My kids don't get out of school until mid-July, the 18th. So we're kind of later in the season. I think we're probably the latest district in Orange County that gets out. But we're starting that summer season, right? Planning vacations, people are out of town, that sort of thing. So overall, this is a slower time of the year. Compared to last year, it's probably going to be pretty much in line when you see the year over year numbers, just because of where rates are now versus where they were. But understand that rates started to come down towards the middle end of last summer and things started to pick up a little bit. So depending on where rates are at that time, you could be, performing better year over year with some numbers, and then all of a sudden it changes. But we'll be here every week to give you that update. G Money says, is there anything the feds can do to temporarily help lower mortgage rates? Yeah, there's a lot the Fed can do, but unfortunately the Fed is not going to do that. The Fed is in a position where they are seeing the economy still grow on paper. GDP again is, the first quarter was negative. Now we're showing 2.4 on GDP. We're seeing employment numbers continue to come in fairly well. Unemployment numbers are still in line with where they want to be. So they're not seeing a huge slowdown in the economy, something that would warrant them lowering the Fed funds rate. So probably going to stay higher for longer, which means you're probably not going to see a big move in mortgage rates. They could have an impact, but the reality is they're not going to do anything to stimulate the economy, because if they try to stimulate the economy now, what happens is, lower rates help stimulate growth to the economy, which in turn has more people spending money, businesses borrowing money, people spending money. Guess what? That goes to inflation. Inflation starts to go back up, then we have that problem again. So inflation is still above the Fed's target. The employment numbers still look good. You're probably not going to see any real moves in mortgage rates. There was a prediction for the Fed to lower the Fed funds rate, and I think June was the first rate cut. I think Bostic came out yesterday and said he sees a world where maybe there's only one rate cut this year. Again, I take that stuff at face value because you don't, we're 5 months into the year. There's still 7 months remaining. A lot can happen in 7 months where the Fed changes their plan. But at the moment, I don't see a reason for them to do much, quite frankly. So, let's see. Oh, yes. Remediate is the term. That's what I was looking for. So when you're a solo man and you can't think of the word, you just got to make up things, and that's what I did. I think I said fix it, and remediate was what I was looking for. Laura is in Salt Lake City, so thank you for being here, Laura. Let's see. Paul says, do you think rates will be higher than the 7s by August, my closing date? Honestly, I can see a world where rates are higher, and I can also see a world where rates are lower. I think for the better part of this year, we're going to see rates probably between that 6.5% and 7% number. I see an opportunity for rates to move lower, but that means the economic data that comes out is a lot worse than what we're seeing at the moment. And so for the time being, I think status quo. It's taking a lot worse news to move rates in a meaningful way than it is taking positive news for the economy to move them higher very quickly, if that makes sense, right? So not a lot's happening out there in the economy in a really either way, good or bad way, and yet rates are trending higher. We've had better than expected news on a couple of different things, and worse than expected news on employment, which should be good for rates, and rates haven't moved. So it's kind of this weird game at the moment where we're in this, I don't know, weird spot in the market where things look good on paper. So as long as it continues to look like that, we're probably going to be treading water here like we have been for the last couple of months. All right. Blue Static VS says, this need to keep going up. We are starting to reduce inflation. If they reduce rates now, it will undo all of that counterinflation. And you're not wrong. If they brought rates down in any sort of meaningful way, inflation would definitely probably spike a little bit, and that kills what they've been trying to accomplish for the last 3 years or so. So that's where we are at the moment, and not a lot of questions. So there's 85 of you or so on at the moment. Not questions, no more questions to answer. So start putting those in there, and we'll get to them. If you have something to say, I would appreciate it. And if you haven't done so, I haven't mentioned this just because you guys are typically buyers, but I do have a second YouTube channel that I started outside of the Educated Home Buyer. So the Educated Home Buyers with Josh and myself, but I started a channel on helping people sell real estate. It's all about selling real estate. It's how to sell your home. So if you haven't done so already, you can check out that channel. That's exactly what it's called, How to Sell Your Home. Just kind of walks you through the process, the things that you need to be thinking of as a seller when going through that process. So if you're somebody out there that is considering selling, really good place to start. Kind of go over those things to help you get top dollar. And at the same time, if you're somebody who's looking for an agent to help you sell, that link scrolling the bottom there will get you in touch with myself, my team, and we can definitely put you in touch with somebody to help you get that process started if you don't have anyone in mind. Sir Williams says, in my opinion, with all the volatility, when do you think we'll see low 6s, high 5s on interest rates? I thought at the beginning of the year, I thought there was an opportunity to see it this year. I still think there's an opportunity to see rates in the 6s, in the lower 6s, below 6.5, but it definitely means different data than what we're seeing at the moment. If employment continues to outperform, inflation continues to show these spikes, then we're probably not going to see that. What you need inflation not to spike with the tariff stuff that's happening out there in the market, for the market to kind of calm down a little bit, right? A lot of the volatility out there in the market is unknowns, the unknown of what's going to happen with tariffs, the unknown of, some of these different things. And so until you get some certainty, you're gonna have volatility. Volatility is not good for interest rates. It's not good for the direction of rates. So for the foreseeable future, I think we're gonna trend higher. Like, I don't mean higher from here. I just mean higher than we would have otherwise trended without this whole tariff talk, right? Had Trump come into office and not done anything about tariffs, I think there's a really good chance that rates are probably lower than where they are right now. While he's out there demanding lower rates, the reality is this isn't a political statement. That the reality is the tariff thing caused the volatility, which caused interest rates to spike up a bit again. So it's not going away. Tariffs, you saw in the charts that we looked at the top of the show, that they have come down. The percentages come down, but at the end of the day, it's still having an impact and is likely going to continue for some time. So we need some certainty. Augustine, oh, no, that's not that. There we go. Augustine. What info do you have about the housing market in Columbus? I don't have anything about the housing market in Columbus other than that chart that I showed at the beginning of the show, which was this one, right? Let me put it up there. I'm going to find it here for you in a second. This one right here that shows that Columbus, Ohio, at the top there is still outperforming. So if I'm looking at this chart and trying, without knowing Columbus, because I don't know what's happening there, other than looking at the data, if I'm looking at that chart, that tells me the housing market is still really strong. That means that housing prices are still selling above asking price. They're still continuing to grow. It's probably a competitive market. If you're there, let me know, because I'd be interested in seeing if that's accurate based on the data that we're getting from Resi Club. JM says, I close on June 30th. Builder offering $15,000 and a 7 1/8% interest rate. Should I use for buy down or closing costs with a 2-1 buy down with whatever is left? So, I personally don't like buy downs, but that's me. Buy downs are one of those things you're temporarily buying down the rate with money. All you're doing is subsidizing the payment with the money that you're using there, right? That's all that's happening. And so if you believe that interest rates are going to trend down in the future, I would rather you use that money towards closing costs. And then that way you don't have any sunk costs on an interest rate. If and when rates move down, you can refinance without having to think, well, I have this buy down now. Does it make sense? And starting to go back and forth. Now, the caveat is if interest rates stay at 7 1/8 for the next 2 years, then your buy down might have made sense. Hard to say. I don't think that we're going to be at this level forever. But again, I don't have a crystal ball either. So you got to do what's right for you. But either way, I would personally be using it for closing costs if it were me in those shoes. Jed is dropping some truth. So Jed is not me. Jed is me with a different letter at the end of my name, in case you were wondering. But I think he was talking about me either way. So I'll take it. I'll take that. All right, guys, we are 33 minutes into this show, and you guys do not have any additional questions for me. So that is a problem, because otherwise we either sit in silence or I just ramble about nothing. Let's talk about my face for a moment. So typically I have a beard, at least something there. Today was a problem. Went to shave this morning, not shave, went to trim the beard. Guess what? Clippers got jammed. Started making crazy noises, pulling hair. I didn't have an option. I was halfway done. The other side I couldn't do. I had to cut ties, guys. I had to lather up shaving cream and shave the face. It's the first time I've had baby face. I look like an old man. But first time I've had baby face like this in quite some time. So wife's not digging it, getting a lot of questions as to why. It was merely an accident. I will not let that happen again. But MF apologized, said Jeb. No apology necessary. Appreciate you. Steve says, how soon do you see the market shifting to a buyer's market? I think in some areas out there, it is a buyer's market. Not everywhere. It's definitely more balanced, but I think it's pretty close to a balanced market in a, take the Northeast out of the equation because again, that market's crazy at the moment, still low inventory. Most areas, I mean, here in Orange County, technically, if you look at it, it's not a buyer's market, but I'll tell you that there are opportunities out there that favor buyers in this market more so than sellers. So I think as we move through summer, if rates stay here, that it is going to continue to trend in that favor. So just give it a little bit of time, and you're probably going to see more opportunities out there. Just you need sellers to cooperate and be realistic at the same time. So we've got, let's see here. Got Paul. Paul, what is Paul saying? Paul is KB is giving me $25,000 in incentives to buy down or use towards closing costs, but the lender is charging almost $22,000 for closing costs. So here's the thing: a lot of people lump in closing costs, right? I'm guilty of this. When I say closing costs, a lot of times I'm talking about title fees, escrow fees, prepaid taxes, your impounds, all of that. Those technically aren't all closing costs. Some are prepaids. But what's included in that 22,000? Are you paying points to buy down the rate? Are you paying processing fees? Anything in box A is going to your lender, right? So look at box A on the loan estimate. That money is essentially going to the loan company who's doing your loan. So if they're, some cases you could be overcharged because they're giving you an incentive. They're just offsetting that incentive by charging you money in other areas. So look at box A, and then also talk to another lender. I don't know if KB is still going to give you $25,000 if you don't use their lender, but if they are, then it's worth shopping around and at least get a quote. And either way, get a quote and just compare it to make sure. A lot of times it's very hard to compete with the builder's lender these days because they are offering really good incentives that you can use towards closing costs and buying down the rate and that sort of thing. But just understand, you need to figure out where that 22 grand is coming from. I would say, reach out, you can reach out using that link that's scrolling right there, or you can email info@theeducatedhomebuyer.com, info@theeducatedhomebuyer. Send us a copy of the loan estimate. Josh will actually review it, and he'll get back to you and just tell you, hey, this is what it is. And you can see, know exactly where the money's going. Can you put a link to the new channel on how to sell real estate? I'm getting old and it won't make it and it'll make it easier for you. I will. I think it's like youtube.com/ Jeb Smith HB, I think is the channel name. Jeb Smith HB is what to search for. So hopefully that's helpful versus me putting in the link. Do you think the lender is taking advantage and wants to eat up most of it? Could be. Like I said, it could be, but without seeing that loan estimate, I do not know. I already answered that one. See, look at that. 10 years younger, Heather says. 10 years younger. Thanks, Heather. You know my Whoop age? So you guys, I don't know if you know what Whoop is. So Whoop is this fancy little thing on my arm, measures my health. I've been wearing it for over 5 years, almost 6 years I've had this thing on. And it measures my sleep, it measures my strain, it measures all these different things. Well, I just got the new one. And part of the new one is that it gives you a Whoop age based on all of the metrics that it measures, right? Looks at your blood, it looks at everything. And guess what? It says I'm 35 years old. My wife doesn't like to listen to this, but it says I'm 35. I'm actually 45 years old. So it says I'm 9 years younger, guys. So now I'm going to start telling people I'm 35 based on my Whoop age. And that's what I'm going with. So you're saying I look 10 years younger. Whoop is telling me I am 10 years younger. Something to be said here, guys. I think there's a trend and I'm going to go with it. But with that said, if you're not wearing a Whoop and you want to wear one, reach out to me. I can get you a discount code. And I'm not sponsored by them, but we both get something. So it could be helpful. But I love it. I think it's great, especially if you're into fitness and want to see, if you're a data person. All right. Let's see what we got here. Hold on one second. I'm having an issue with charts. What is going on, guys? Sorry, I gotta change something. Oh man, what happened? Sorry. I'm working off one screen trying to look at stuff. All right, here we go. What we got? All right, I answered that. Heather told me I was 10 years younger. I appreciate you there. MF says Ventura County is still strong with solid multiple bids. I think that, I mean, that's the same in Orange County too, but there are also opportunities out there. Not every house is like that, right? It's taking a little bit longer for things to happen. Willing, did I ever consider radiology as a career path? I did not. I did not want to spend another 4 to 8 years in college in medical school, nor was I probably as smart to be able to get in there. But I do have a friend who's into radiology. I mean, she's a radiologist and a partner in a practice. And looking at what she does, I probably should have been a radiologist. You know, I want to be, the guy that does the epidurals. Like those guys are the real winners in this whole medical field. Anesthesiologist. That's the real game changer if you want to be in the medical practice. High risk, high insurance, but it's one of those jobs I'd like to have. Alfredo, if I send your address of a house, would you please let me know your point of view? If it's in California, in my market, I can give you some thoughts. Outside of that, it's very difficult for me to do because I don't know the areas and the markets well enough to be able to guide you, but you can give it a try. Let's try it. Send it to me and we'll see what happens. Let's see here. Is rent in the OC trending up? So I don't think it's trending up. It's probably flat for the most part. It depends on the price point, right? I think if the lease is if they've been keeping up with the annual increases almost yearly, then it's probably flat. If rents are behind because landlords have not been keeping up with the annual increases, then you're probably still seeing them increase so that they can get to where market rent is, if that's helpful. Scott, is a good time to sell a house? Are you expecting a house market collapse? Is it a good time to sell a house? Could be. Could also be a bad time. Depends on what your goals are, Scott. It's, what you're trying to accomplish. What do you just did a video on this. It's coming out next week on the other channel. And I talk about, why you should not sell your home. If you're selling because you're chasing the top or what have you, then I think that's a terrible idea because, take it back to clients that I had in 2019 that sold because they thought we were at a top. They got priced out of the market. They still do not own a home today because prices shot up. And since then, rates have gone up and they can no longer buy where they were expecting a crash to happen. And so I don't think trying to time the market is the smart thing. Every single year, people think, well, this is the top in prices. And prices continue to grow. I think realistically, depending on where you are, home price appreciation keeps up with probably the rate of inflation, right? So 2 to 3%, somewhere in that ballpark is where I see home prices continuing to grow probably over the next 5 to 7 years. So, but at the same time, if you're somebody that is moving out of state, buying something else, doing something else, and you need to sell for that reason, then sure, I think it's a great time. But it also depends on your market. And without knowing that, it's difficult to give you a more detailed answer. Do I stage most of my houses? What are my thoughts on staging as a seller? I think it's crucial. I think if a house needs staging, some houses don't need it. Like I shot a house today in Huntington Beach that did not need staging. It looks good as is. We had to declutter it a little bit, move some things around for photos, but the house showed really well. On the other hand, I have a house coming up in Cypress in next couple of weeks that's going to be vacant. We're going to stage that house because it's going to show a lot better with staging versus not. I've done videos on that other channel too about staging, showing you before and after photos. It makes a difference for the cost. It pays for itself every single time. So I would 100% stage. I would even do it on my own house if if it were me selling, if I didn't think my furniture fit. So just a heads up. Sir Williams, what is paid by others in box A? Nothing. Everything in box A is paid by you. Box J can have credits in them to offset some of the things in box A. But at the end of the day, box A, everything in box A should be considered points. Doesn't matter what they call it, whether it's, discount points or points or processing fees or encompass fee, whatever they want to call that fee, just say it's a point. Everything in there added up is what you're paying in points for that loan. So, but again, if you're getting credits, if you're being promised credits, that comes in the on box J if you're being offered that. All right. Willing says, my birthday is next Tuesday. I'll be 35. Should I be concerned about more body aches? Not at 35. 40, it's crazy. Everybody says 40, it happens. 40 for me, it really did happen. It happened during the pandemic. I turned 40 March of 2020 when the pandemic happened. And that's when everything really started at my back. Everything started bothering me. So there was something to be said about that 40 number, but it's only a number. Just keep pushing forward. Keep pushing forward. Miguel, I'm purchasing a manufactured home. New, would you still recommend home inspection even though builder does their inspections through them? So I like getting my own home inspection. Understand that the builder's inspector works for who? The builder. So I like doing my own home inspections on new construction because these inspectors will find things that typically the other builder, the builder's lender or inspector might not find. It's going to cost you, a couple $100 to do it, but in my opinion, it's worth it. So to each his own. You have to decide what's right for you. But that's the way I would go if it were me. All right. Let's see. What phase does title, deed, ownership, buy down, and closing costs fit in the right timeline for purchasing a home on a first-time home buyer? What phase does title, deed, ownership, buy down, and closing costs fit? I'm not sure I understand the question, Sam. So if you want to put that in there and maybe explain to me what you're asking exactly, I'll try to help answer it. Do I think rates are in a bubble currently? No, I don't think they're in a bubble. I think there's reasons that interest rates are high. Could I see an environment where they move higher? Potentially, I do see an environment where they could move higher, but not a lot higher. I see an environment where they move lower too, but also not a lot lower. So I don't think they're in a bubble at the moment. I don't see that happening. Undone. Process of closing on a new construction, moving from California to Texas, 1 year buy down, 4.99%, then jumps to 5.99 for year 2 to 30. Disappointed the 4.99 isn't for 30 years, but let's see here what's happening. But still happy. Yeah, I think you should be happy. At the end of the day, if you can keep a 5.99 in this environment, I think there's reasons to be happy with that. That's a pretty solid interest rate, no matter how you cut it. All right. I am really having trouble over here with this screen. One second. All right. Okay. So Sam follows up to clarify question and says, I was wondering if all those things occur when you are in contractual agreement solely with the mortgage lender or they occur separately. So let's see, go back up to your question here just to make sure I have the question. And you said, here we go. What phase does title, deed, ownership, buy down, and closing costs fit into the timeline? So the title's going to happen. Title's going to get ordered when you're going through the process, right? It's going to happen. Here in California, we have an escrow company. Escrow typically orders the title report, right? The title from that the seller pays basically ensures a clean title, right? But if you're getting a loan, the lender is going to want to make sure you have a lender's policy on that. That's going to happen through the escrow process. Not really something that you need to concern yourself with, but it is smart to pay attention to the title just so that you can see if there's any easements, anything happening that you should be aware of. And again, any liens on that title should be taken care of prior to you actually owning that property. The deed, getting the deed, you're going to sign the deed, at least here in California, as part of that escrow paperwork. It's going to have to be notarized, but it doesn't actually get recorded until closing, at which point you sign loan docs, you do that whole thing, then the deed gets sent to the county and gets recorded. So that happens at closing. In other states, maybe it happens differently, but they don't record the deed until they know the deal is done. They have the funds, all of that stuff, because otherwise you would have an owner who doesn't actually own the property. Rate buy downs, closing costs, all that happens through the process. You're going to get loan estimates, you're going to get closing disclosures, that sort of thing, that show these different fees, how much you're supposed to bring in. All of that's going to have your closing cost on it. Your loan estimate, one thing that we've talked about here on the show, is going to come up in that process, and you're going to review it. It's going to have buy downs on there. It's going to have all of that. And then it's going to essentially tell you, how much money you need to bring in at closing. That's going to be what you bring in, or what you wire into closing or bring in, at the closing table, in order to actually close on that deal. So hopefully that answers your question. I'm not sure if I got it 100%, but hopefully that was what you were asking. All right. This from Diego. Diego says, if I bought a house from a friend and he sold it to me under market value and it appraised 50,000 over the buying price, can I refinance in 6 months and use that equity to drop PMI? It depends. It depends on what it appraises for. So just because you got it under market value doesn't necessarily mean that the appraiser is going to see it that way, right? So if there's comps there to support a higher value and the appraiser brings it in, there's an opportunity for you to potentially get the PMI off. But most lenders are going to want you to own that loan, I think, for at least a year. Some cases a little bit more before they'll reduce that PMI. So I would talk to your lender before closing on it just to see how they work through that process. It's a good question, and you should ask Josh next time he's here, which will be back next Wednesday. And we can go over that question. If you haven't moved forward by then, and we can get you a better answer, but, I don't know if you can do it as quickly as 6 months. I think you're probably going to give it a little bit more time. Miguel says, is escrow better paid on a monthly basis or pay in full at the end of the year, or is it more of a headache? I pay my escrows, my impounds, with my mortgage, right? I impound so that my taxes and insurance are paid every single month I make my mortgage payment. That way, when I get the bills, I don't have to worry about it. I don't have to come up with a lump sum. Our property taxes based on our purchase prices here in California can be really, really high. And I don't want to come in with a huge amount. I don't like getting that bill, even though I could put the money aside. I just rather pay it and it gets taken care of. Whereas other people would rather have the funds and do it themselves. The reality is keeping your own funds in a bank account, savings account, that little amount is going to earn very little interest. So it's not really a huge benefit there, but some people want to control their money. So it's, a personal decision whether or not it makes sense for you. All right. Let's see. Heather says, is the free money from the state still available to help with first-time home buyers? So it's not from the state. Well, depends on what program you're talking about. If you're talking about the program where there was $50,000 in LA and for certain areas, and then 20,000 here in Orange County, basically the Southern California one that I mentioned, that's still available, but it's no longer $50,000. It's $20,000, and it's not from the state. It's from the bank that was actually doing the loan. So I know you're in Inglewood. They're still giving $20,000 out in those markets, but you have to use that lender. You have to qualify. You have to do all that good stuff. So if you want that connection, let me know. I'll get you in touch with Chris, and he can guide you through that process. I'm going to take a sip of water here real quick, guys. Because I've been talking for an entire, well, not quite yet, 50-something minutes. So again, yes, that program. So Heather, reach out. I'm happy to get you in touch with Chris if you haven't talked to him already, and see what you qualify for. We actually closed one in Compton. When was that? Probably 2 months ago. And he got the 50,000. It was great. $50,000 of free money, and it was awesome. But now it's been reduced to 20 grand. Okay, here we are. If you're finding any value tonight, I know I'm here by myself. If I've helped you at all, do me a favor, hit the thumbs up. consider subscribing to the channel if you haven't done so already. And check out the Educated Home Buyer. The podcast we did this week just kind of shows the home ownership over a 30-year period of time versus what the stock market has done. Just kind of, building that foundation of owning, owning a home, why homeowners have a 40 times greater net worth. We talk about it in the episode, things that you've heard many, many times here, but we actually walk through real numbers, real percentages of what happened during that period of time. So if you haven't checked it out, it is on the podcast. It's also here on YouTube. Make sure you take a listen, and hopefully find some value in it. Jay Beltrain is asking if rates are going to drop. It's insane. Basically saying who the hell is going to be able to afford these homes? Yeah, affordability sucks at the moment. Some of the worst affordability we've seen. California just hit a new median home price here, over $900,000, highest that we've ever had on record. Yeah, that's a problem. Higher rates, higher prices, affordability low. You're gonna see, a slowdown, right? That's why one reason why I don't think you're going to see home prices continue to grow at the rate that they have grown, or barely at all, is because of affordability, right? If we do see a big drop in rates, then that could change, but I don't see a world where we see a big drop in rates without seeing major headwinds in the economy, major issues in the economy, which quite frankly, we don't want to see. You don't want to see interest rates back at 2% again, 3% again, because if you saw that, that means there's a much bigger issue happening. And, I'd rather see a little bit higher rates and a decent economy than vice versa. All right, guys, it is that time, almost an hour on. I appreciate you being here. Appreciate you watching. Appreciate you supporting the show. If you found any value, do me a favor, hit that thumbs up. If Josh or myself can be of any assistance to you, walking you through that home buying process, pre-approval, any of that stuff, you can use that link scrolling in the bottom of the screen, jebsmith.net/start. If you're waiting to refi your interest rate, waiting for lower rates, want us to watch it for you, it's jebsmith.net/rate watch. Either way, you can get in touch with us, the team. We can guide you through the process, help you become the educated home buyer. Until next time, make sure you buy right, borrow smart, and build wealth. Adios, amigos. See you then.